Hey everyone, Warren Buffett owns 45 stocks in his Berkshire Hathaway portfolio, and in this video I'm going to bring you one that's an excellent stock to buy for passive income investors. That's right, a dividend stock from Warren Buffett's Berkshire Hathaway portfolio that I think makes an excellent investment for 2024. I'm going to share with you why I think that's the case in this video, as well as sharing with you, of course, what the stock is. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the stock that I'm going to be talking about in this video is MasterCard. MasterCard is the dividend stock in Warren Buffett's portfolio that I think makes an excellent investment for passive income investors. Of course, MasterCard does not have an extremely high dividend yield. In fact, it's a relatively small dividend yield at 0.55%. But more importantly is the total return you can possibly earn by investing in MasterCard stock. And one of the things to look out for passive income investors, I'm going to share with you in the next slide. The dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable, because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example, where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. That being said, you can see MasterCard only at a payout ratio of 19.19%. And what I just shared with you earlier, you can see that MasterCard has plenty of room to grow this dividend over the next 5, 10, 20 years. MasterCard's revenue has increased from around $9 billion in 2015 up to $24.37 billion in the trailing 12 months. MasterCard takes a percentage of every transaction and a small fee from every card transaction using a MasterCard. That means that it's positively correlated with inflation. As inflation increases, MasterCard's revenue will increase because its percentage of transaction will go up, right? If you're spending $100 one year and then $108 the next year, for the same basket of goods, that's an increase in nominal value, which increases MasterCard's revenue as well. So it's positively correlated with inflation, and we've known for the long run, inflation tends to stay positive and fluctuate. So you'll have those years like we did in 2021 and 2022 when inflation was elevated. And if you were a MasterCard investor, you saw your revenue increase. As you see here, that nice trend upward in revenue from MasterCard. It's a nice little correlation, and it offers a bit of inflation protection for investors. Not total inflation protection, but a bit of inflation protection because you get to benefit when inflation increases more than expected. And one of the primary reasons why I like MasterCard stock is the excellent operating profit margin. MasterCard operating profit margin 57.96%. That's up from around 56% in 2015. So it's been able to maintain this elevated operating profit margin. It wasn't like it was a one-time thing because of circumstances in 1 year. This is consistently what MasterCard does, and it's been slightly increasing it over time. In fact, the most profitable company that I know of is MasterCard's rival, Visa, which has an operating profit margin of over 65%. And before you ask, yes, I do recommend Visa stock as well. I think Visa and MasterCard are both excellent dividend stocks to buy for passive income investors. And one of the more important reasons why I think that's the case is because of their incredible profitability. And another reason they've been able to maintain this incredible profitability is because they don't compete fiercely against each other on price. They don't lower prices and offer higher and higher incentives to steal customers away from each other. And that's why they've been able to maintain these elevated profit margin, is because of reasonable competition based on differentiation and not on price. And that's where I like to invest, when the competitive forces are not fierce. Also, MasterCard's balance sheet, relatively strong position, 15.5 billion in long-term debt, 7.5 billion in cash and short-term investments. While they do have more long-term debt than cash and short-term investments, the company's incredible profitability and the incredible profit margin leads me to feel that this is a comfortable amount of debt, given that it can generate enough profits in 1 or 2 years to comfortably pay down this debt if they needed to. So you're getting this excellent business with remarkable profitability, the potential for dividend growth over the next decade or more, and you're getting it at just about the cheapest valuation you've been able to get MasterCard stock for. Right now, it's trading at a forward price to earnings of 24.98. You were able to buy it a little bit below at one point in late 2022, but that's it. Going back the last 4 years, you haven't been able to get MasterCard stock at this value. So you get this excellent business and you get it at an excellent price. For those reasons, I say this could be a no-brainer Warren Buffett dividend stock to buy for passive income investors. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.